Every single month, I have two series of videos that I do. One of them is two undervalued stocks to consider. This is you guys' favorite, where I talk about cheap stocks trading at 5 times earnings, 10 times earnings. Some of them are value traps, but some of them end up being amazing winners. We talked about them many times before, Crocs and Geo and many others. The other one I do is two undervalued dividend stocks to consider, where I discuss two undervalued dividend stocks. And I decided to start something new, and this is two high quality stocks to consider or to buy in the stock market. As the market is getting a little bit more expensive, it's a good time, in my opinion, to look for some quality stocks that are, trading at fair price, not as a cheap of a price that I usually buy at 5 and 10 times earnings. I do sometimes buy high quality companies trading at fair value. They're not crazy, cheap or whatever, but they are, fairly valued because they are more of a quality company. And Warren Buffett said it himself. He said it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And most people don't understand what it means until they buy a value trap like maybe MPW and lose money because it looks cheap and it just keeps getting cheaper. This is how I lost money also the hard way, buying a lot of the cigar butts that didn't work out. Then I learned kind of how to value them a little bit more. But sometimes they can be tricky. And Warren Buffett knows what he's talking about. And this is why over time I've been doing less of the, trading value cigar butt stocks, and I've been buying more quality stocks for the long term. In this video, I'm going to share with you two high quality stocks trading at a fair value right now in this overvalued stock market. If you enjoyed this video, let me know in the comments so I can do one every single month. Now, the first stock, which I've never talked about before, the second one also, but the first one, it needs no introduction. This is LVMH. Ticker symbol LVMUY on the OTC exchange for US investors. This company has been weak lately with the rest of the luxury sector. Even Nike has been a little bit weak. Nike is not luxury, but these kind of brands is sitting at $144 per share at the same price it was sitting at in 2021. EPS is up over 35% from May of 2021. In May of 2021, it was trading at 30 times earnings, 36 times earnings, and now sitting at 20 times earnings. So the company is much better valued, and the market has been pessimistic about it, and it's sitting at $144. Again, LVMH needs no introduction. Most of you know the CEO. He was the richest man in the world just right before Elon Musk. Now Elon Musk is the richest man. And this company owns a lot of brands that most of you know and maybe buy and are familiar with. So I'm not really going to waste your time a lot on explaining to you what LVMH is. But LVMH has been surprisingly growing organic growth, double digits, which is surprising for a company that's of the size of LVMH. And even though we have much higher interest rates in many economies around the world, in many countries, even though we have some kind of a slowdown, if you want to call it a slowdown, LVMH is still putting double-digit numbers. And this has been astonishing. In Japan, growing 31%. In Asia, 19%. Europe, 16%. United States has been the weakest, around 3%, which gives them 14% total organic growth. And if you look at this chart, this company does a lot of acquisitions. So without doing acquisitions, they're growing 14% organic. This is amazing for this company. And if it does hold trading at 20 times earnings, this is undervalued, not just fairly valued. It could potentially be an undervalued company for something like LVMH if everything holds up. Now, in terms of wine and spirits, this has been the weakest side of the business. It has been declining, but fortunately, it's one of the smallest, pieces of the businesses. The highest one is, of course, fashion and leather goods. Then they have some perfumes, watches and jewelry, selective retailing, and many others. But wine and spirits has been very weak, especially in Latin America. You could look at a stock that I believe Warren Buffett used to own. I'm not sure if he still owns it, but this is DEO. DEO, they own Johnny Walker whiskey and bourbon kind of brands and many other popular brands, vodka and many other ones, And it's sitting now at 141 for the last 5 years. It has been extremely weak, but especially over the past year, it's down 24.5%. And this is only a wine and spirits focused business. And fortunately enough, LVMH is not just focused on that. So this has been the weakest part of the business. Everything else is putting up 26% organic growth, and it just surprised me how much this company is still growing and for the size of the company at all. Now, it's sitting at 20 times earnings. I talked about this. The mean of over the last pretty much 12 or 13 years, it was 21 and a half. Now it's sitting at 20 times earnings. The company and the stock got euphoric, went to 40 times earnings in 2021. And since then, it corrected. It's now sitting at a 20-time earning multiple, which I personally believe is fair for a company like LVMH, especially if they continue growing double digits growth for the future. Now, in terms of the growth in general, they used to grow double digits before COVID. This was not just a COVID story. Before COVID, LVMH was growing 11% EPS, 29%, 23%, 12%. Then they grew 156% in 2021. 2023 has been around 12%. But the main reason the stock has been weak is because a lot of the analysts are expecting a slowdown this year in 2024. They are expecting LVMH to only put up 5% EPS growth, then a rebound to 9 and 10%. No one can really predict the accuracy of the EPS per share. What is it going to be? But I think the economy has been resilient and has been surprising most people, especially around the world, not just in the United States. So I would say that maybe LVMH can beat the estimated 5% EPS growth. But for a long-term return, for me personally, I believe LVMH can grow EPS 8 to 10% a year, just like it's expected to grow in 2025, and just like it used to grow before. So if it grows around 10% a year of EPS with the buybacks, and they have the dividend, which is like almost 2%, this is a 10 to 12% return every single year for the next 5 years or whatever for LVMH. And this does not include the multiple expansion. Maybe something happened, LVMH beats on earnings, the stock gets a multiple re-rating, and it goes back to 25 times earnings, what it has been trading over the last 5 years. That would be around 13 to 14% return, which is not a bad buy. I mean, if I had a lot of cash and I was just looking for a stock to buy in this overvalued market, I don't think LVMH is expensive, but it's not cheap. It's not as cheap as the stocks I talk about on YouTube. But this is, again, a quality company. You have to pay up for these kind of companies with a moat and some brand value and recognition, and it was a pretty good CEO. So I think LVMH is fairly valued. I see around a 10%, 11% return over the next 5 years. With a multiple expansion, I see up to 13 to 14% return, which is not bad at all. This was the first stock that I had. The second one is a stock that I've never talked about before, and I believe it has a higher potential of compounding 14 to 15% annual for the next 5 to 10 years, even a little bit longer. It's a recession-resilient business, unlike LVMH. LVMH is a little bit more cyclical. The second one is more of a recession-resistant business, and this is a company called Alimentation, ticker symbol ATD, on the TSX exchange in Canada. I believe they also have an OTC listing, which you could purchase, but I normally tend to buy, stocks in Canada. If I buy them, I just buy them on a Canadian exchange. They are a little bit more liquid. I use IBKR, and I have a link in the description if you're interested, but this is the brokers that I use to buy a lot of the micro caps trading on the TSX Ventures, especially the small one. They are more liquid in Canada, but ATD is a company that most of you have never heard of, and it's one of the best performing stocks of all time, sitting at a 17,000% gain since it went public, I believe, in 1999. I mean, most of you have never heard of that. And this is a very simple business model. ATD is a convenience store owner. They own the convenience stores. If you remember Circle K in the United States, they even have some in Europe. A lot of the Circle K stores, they own the Circle K brand. And so we have a few more brands. And convenience stores are a very interesting business, very boring. And you could see the results, over 17,000% over the last 5 years. This company is up 119%, which is why I try to tell you guys on YouTube that a lot of you believe you have to buy the hottest thing in the market to make returns. You have to jump on the next train, the next plane, whatever it is, the next AI or the next crypto coin. You don't have to do that. Sometimes just buying boring businesses that can do well no matter what can get you 15, 20, 25% annual. And, like something like Constellation Software is like one of the best of all time. This is why I've been looking a lot in Canada for smaller and micro caps. But these companies, no one has ever heard of them. Very boring. I'm like, convenience stores, who buys them? Well, up 120%, 17,000% over the last 20 some years, which competes with a lot of the tech stocks. But they own a lot of these convenience stores all around the world, over 14,425 stores. Most of them, of course, are in the United States. And they have over 8.5 million customers served per day. So they have scale. And the best part about it is that they are pretty much all over the world, so they can expand and do many other things that they did. They also have been doing a lot of acquisitions lately. For example, they acquired car washes, and they've been putting these car washes pretty close to the convenience stores, and it's pretty smart stuff. The company is smart. They know what they're doing. Amazing team, amazing management with the right incentives and some skin in the game, which is very important with these companies. Now, I know what a lot of you are going to say. You're going to say that EVs are a future and no one's going to go to a gas station anymore, so therefore the convenience stores are going to suffer. Well, ATD is doing something about it. They opened something in Norway where it's some kind of it's not kind of a charging station, but it's kind of like a convenience store, but instead of the gas pumps, they have, Tesla chargers and many other EV chargers. And they actually made more money in this station than in the gas stations. Now, if you know anyone that owns a gas station in the United States, they don't make much profit. It's something like 7 or 8 cents per gallon. I forgot what it was. But most of the profit is made inside the convenience store. It's not made from the pump. And whenever you're charging your car, you're going to spend a little bit more time in your car until it gets charged. So you're likely maybe want some chips, you want some cookies, you want to drink something, or maybe play the lottery or do whatever. So people spend more time over there and they buy more things from the convenience stores. So this actually has the potential to help their business, not hurt their business. And I know it's a kind of a concern to a lot of you that maybe gas stations are going away. Well, there's a solution for it, and convenience stores are always going to exist. So it's a pretty resilient model, and I'm not worried about EVs with this company. I don't think it will hurt them as much as most people believe. Now, in terms of the companies, they have a target return of capital employed around 15%, which is very important to estimate the return of the stock over the long term. Most of the stocks, they tend to trend around the capital employed, so around 15% every single year. It's been 17.5% return on capital employed. But if they do hit the 15%, we just have to make sure we are not overpaying for ATD. ATD is currently sitting at 18 times earnings, which I believe is a little bit on the higher end, even though if you look on a historical average, the mean has been 18 times, the highest was 28, and the lowest was 8.5. I believe it was in 2008, 2009. If you look over the last 10 years, the mean was 19, it's now sitting at 18. So again, ATD is not cheap, but it's trading at a fair value. And I believe if you hold ATD for the long term, your return should be closer to the return on capital employed, which is around 15% annual. Now I'm just going to give you a little tip. If you want to purchase ATD sometime in the future, this has been holding the trend line since 2022, and every time it touches the trend line, it bounces from it. So if I had to buy ATD today, I would personally wait and see if it gets close to the trend line around $70, $71, $72, and I would buy it over there. But if you want to buy ATD right now, and I don't think it's a bad buy. I think it's a trading at a fair value, quality company, amazing management, 15% expected return, higher than LVMH, and it's also recession resistant. Again, it's in Canada, and you could also buy the OTC ticker if you're in the United States. And this has been my video for today. I hope you enjoyed it. It was not financial advice, of course, but if you do enjoy it, please let me know in the comments. So maybe I could do one of those every single month. Thank you again for watching. If you did enjoy it, please press the like button. Maybe consider subscribing. So I hope to see you in another video.